Most traders lose money to the market because they trade with emotion and guessing. But if you understand how to know where the market is going before it moves, you can start trading based on information instead of emotion and guessing. In this video, I'm going to show you how to know where the market is going to before it moves. Knowing where the market is going to before it moves is the ability for you to understand the information the market is giving you every time to know the most likely direction where the market will be going to. And I know the question in your mind right now is, which information is the market giving us to know the direction of the market? Let me now take you step by step on how to do that. For example, when you see the market makes a higher high, higher low, higher high, and higher low, you know that the trend of the market is bullish. But when you see the market makes a lower high, lower low, lower high, lower low, lower high, you know that the trend of the market is bearish. So after knowing this, the next thing is for you to mark out your trading range. So my trading range on the bullish side is this swing low and this swing high. That is my trading range on the bullish side. Then on the bearish side, this swing high and this swing low is my trading range. So after I mark my trading range, it's for me to mark out my premium, discount, and equilibrium level, which I'm going to talk about in a separate video. That's why you need to like this video, subscribe to this channel so that you get notified whenever I post the video on this channel. After you mark out your equilibrium, discount level, and premium level, the next thing is for you to mark out your point of interest. So my point of interest on the bullish side is going to be within my discount level, either a fair value gap or an order block. On the bearish trend, my point of interest is going to be within the premium level, either a fair value gap or an order block. So I mark here depending on what the market shows me for my point of interest. After marking my point of interest, is for me to just wait for the market to come to my point of interest before I will go to the lower time frame to look for confirmation that truly the market wants to continue with the trend before I will enter my trade. Now that you have understand the idea, let me take you to the chart and show you a practical example on how to apply everything together. This is GBP USD. The first thing to do whenever you open your chart is to go to the higher time frame. For example, let's use the 4-hour time frame. On this 4-hour time frame, what we can see here is that the market was bearish at this point. Before, when it comes to this side, then the market changed structure to the upside. So the market here, after the market took this low, it went up a little, it falls back, taking the low again, it went up again, taking this low again here. So when the market took this low, it has to come back to mitigate this movement. So that's why the market went up again, filling this imbalance before the market falls back. You understand? So after the market come to this point, it has to go back again to mitigate again, and then after that it will fall again. So this market, the market gives a lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, and lower low. So at this point, instead of the market to either trade within here and falls back, the market decided to break the structure, giving you a change of market structure. So this is a change of character. So after change of character, you expect the market to come back to fill this imbalance which is going to be like your point of interest, because the market will just come and trade within this point before it goes up again. So what happened? The market just traded, reversed a little, and then instead it went up again. So going up to this point, reaching here, which I know all these markings I mark here is going to be more clearer on the 1 hour time frame. Let me switch to 1 hour time frame. On the 1 hour time frame, this is where I was talking about. When after the market broke this high and it went up, instead of it coming back to mitigate this movement, it decided to continue with the trend. So after taking this up, the market fell back again to this point before it went up. So after breaking this point, the market reverses again to this side. After reversing to this side, then the market went up to this side again, taking this high. And then the market is coming back again to trade within this point of interest. Look at what I mark here. This point here I mark, you can see that the wick of this candle and the wick of this candle, they did not touch each other. So for that, I know that this is an imbalance. The market will likely come and trade within this imbalance before it go, just like it did all these places here. You understand? So when the market reverses exactly to this point, it flies up again. So this, you know, the market has been given a higher high, higher low, higher high, higher low, higher high, and a higher low. So you know that the next movement is for the market to go up again. So the market went up. After taking this high, it reverses a little to mitigate this movement, to fill this imbalance here, and then the market move up again, taking this high again. After taking the high, it reverses a little. Instead of coming to this point, decided to stop here, and then it went up again, taking this point. After taking it, it reverses again, and then it broke the upside before it fall. So this is how the market always move. Whenever it breaks structure, it will have to reverse back again to mitigate that movement. So what is targeting? The market is always looking for a balance within structure. Every imbalance you see, that is where the market is likely going to. The market is drawn to liquidity and imbalance. That is where the market is always looking for. So let me use another example using Euro USD. Euro USD, this is 4 hour time frame. And what you can see here, you know, the market came all the way from bearish to bullish. So here, the market took this low. The market took this low. Took this low. And then it falls back to this point. And it reverses again to this point. Reverses to this point. After reversing to this point, the market fall again, taking here again, taking here again. After the market took this low, it has to go back again. So after taking here, let me mark it step by step so that you understand what I'm trying to do here. This becomes okay. After taking there, the market fall back again, taking this low. After taking this low, the market will have to trade within here and then fall back again. But what happened? The market just fly all the way to the upside. So this point you see here, all this massive movement, you are going to see the clearer picture on a lower time frame. Let's say 1 hour, for example. Let me show you what happened there. Look at here. After the market took this low, it reverses a little to this point. Instead of falling back, it refused to take the low again, and then instead it went up to this point, breaking structure, breaking all these structures. So after breaking those structures, the market is supposed to come back again to mitigate this movement, these imbalances you see here. So instead, the market refused to come back to mitigate it. It reverses a little and then it went up. So after going up, you know that in future the market is going to trade within this imbalance before it go. You understand? So that's why the market, after taking this high, it falls back again to this point. Before, what happened? You see the market going up again, going up again. So that is how to know where the market is likely going to. For example, on this 4 hour, after the market took this low, it went up taking the high, and it falls back to this point, trading just touching the fair value gap before it went up. After touching the fair value gap, it went up again, taking this high. After taking the high, you know that it's supposed to come back to trade within this imbalance here, and then it traded on this imbalance. What happened? The market fly up again. So this is how to know where the market is going before it moves. When you see the market break the structure, let it reverse back and let it come to either your point of interest. When it comes to the point of interest, you go to your lower time frame for you to see a confirmation that yes, this is where the market truly wants to go to before you enter your trade. Here is one thing to remember: don't trade blindly. Unveil the secret of trading with Trading Unveil Academy. If you found value on this lesson, like this video, subscribe to this channel, and I would like to see your comments on the comment section below. Because in Trading Unveil Academy, we unravel the hidden mysteries in the financial market and demystifies the complexities involved in trading. Thank you for watching this video, and I would like to see you on the next one. Bye.